In this episode of Investors and Operators, I am talking with John Koeppel, who is the partner and head of private equity and in the independent sponsor practice at Lippis Mathias. John, I think that you were telling me you've done almost 27 years of working with fundless sponsors. You're telling me that your first fundless sponsor deal was day two in September of 1998, and you think you've worked on over 100 independent sponsor transactions. So,
It's it's been a few. It's been a few, Jordan. Great to have talk to you today.
well, this episode is for independent sponsors who have not done their first deal. Maybe they have done their first or second deal, but this is going to be a masterclass on independent sponsor deals covering the following four topics: pre LOI deal sourcing stage, LOI execution, post LOI during the diligence and the overall process to close, and then lastly, post close. So we got a lot to cover. If you're an independent sponsor, this is for you. John has done over 100 transactions, so listen in. Let's dive into it on the first topic with pre LOI and the deal sourcing stage. So, um, when you have seen an independent sponsor convince the seller to sign an LOI, what did the independent sponsor do that got that signed up?
Yeah, it's a great question, Jordan, and probably one of the more common questions I get asked, right? Because obviously there's always competition for deals, right? A lot of independent sponsors are working on great lower middle market deals. There's strategics, there's larger private equity, right? I've done over 100 independent sponsor transactions, and there's really four key reasons why I see independent sponsors win a deal and get it signed up. Number one, sort of relationship with the business owner. Number two, a seller who's really focused on legacy. Number three, the concept of rollover equity in the second bite. And number four, convincing the seller that you can get the deal closed, certainty of close. Those are really the four key reasons. Maybe we can go back and just spend a little more detail on each one. The first one is why does anyone do business with anyone else? You like that person. You've built a relationship based on trust, right? And maybe you know the industry that the business owner's in, or you've done extensive research, or you have an operating partner or strategic advisor who knows the industry, right? So you can talk the talk with the business owner, right? He doesn't view you as just sort of like, hey, here's someone looking to buy my business and make a buck. No, this is someone who truly is impressed with what I've built and wants to make it even better, right?
On that
Tied
on that
Yeah, go
point for
ahead.
the first one, if you had to make a ballpark estimate, what percentage of independent sponsored deals have been done within an industry that they had direct either investing expertise or even operating expertise versus how many like they bought a consumer business, but they've never done a single consumer thing in their life?
I think in today's market, it's almost 100% in the sense that either the independent sponsor needs to know the space and know that vertical and have experience in the space, and a lot of our clients, are doing that. They're focused on aerospace, they're focused on healthcare, whatever their vertical is, right? Or maybe it's a space they don't know as well, but they've either brought an operating partner, or maybe our part. I've seen it situations recently where one of our clients has found a great deal, has it signed up, and decides to partner maybe with another independent sponsor who maybe brings something to the table that they don't. Maybe they know the industry better, maybe they have deeper capital connections, right? So it's in today's day and age, it's almost unheard of where someone on the I sponsor side of the deal doesn't really live and breathe and know that space, because you're not credible to the seller if you don't.
Okay. And maybe just for a little more context, what do you think is the average deal size of the independent sponsor that you've worked with? I don't know what the time frame is, whether it's
Yeah.
12, 24, 36 months.
I think a lot of the deals we work on, I think a lot of the deals that happen in the market are sort of in that, I'd say 10 to 50 million of enterprise value range is relatively common. We probably most common. I think that 50 to 100 range, seeing more and more deal flow in that space, right, of enterprise value. North of 100 million, you see occasional, we'll see a few of those a year. I mean, that's a pretty substantial transaction, right? Especially if we're talking about younger independent sponsors getting their first deal done. And typically those are bigger transactions, might imply that's a better run company, trading for a higher multiple, not as much
Yeah.
ability to make improvement. A lot of our independent sponsor clients are focused on that sort of 2 to 5, 3 to 5 of EBITDA, maybe that 5 to 10 of EBITDA, where they can go in, roll up their sleeves, professionalize the business, put in some sort of value creation plans, right? And as you get larger, as you start going to businesses north of 10 of EBITDA, a lot of that's been done already, right? And there's
Yeah.
not as much value creation with some of those larger companies.
To what extent have you been exposed to the equity packages that an independent sponsor might propose to a operator who might come in, and let's call it a 5 million EBITDA business, um, and they're hiring an outside executive. Um, what is a ballpark of the economics that an independent sponsor should be thinking about
Yeah, I think, and are we talking about as like a executive in the business or more like an operating partner
running
type
the
role,
business?
running business?
Yeah,
Yeah, I think
5 million EBITDA HVAC business
okay,
in the Northeast that is second generation that even
yep.
exists.
I'd say on the low end we might see 3%. I think the range is probably 3 to 4, up to maybe 6% in terms of profits, interest, or stock options. Right. Some of those might be time vested. Some of those might be performance vested, tied to some sort of multiple or hurdle on sort of return of capital. Right. That's probably the range. And there's usually a co-invest opportunity where the CEO is asked to invest something meaningful to them, right? Meaningful to them. That could be 50,000, 100,000, $250,000, right? But investing an amount that's meaningful to them, alongside getting some stock options or profits interest.
All right. So the second one you mentioned was uh, how there's a situation where the seller actually cares about their legacy. And I mean, how many situations do they not care about their legacy? And then
You know, yeah, and I
talk a little
think,
more
listen,
about that.
every business, yeah, every business owner will say they're concerned about their legacy, right? But I think some of them, is as a lot of our clients will have initial meetings, can sense that it's really, if it's about the last dollar, right, and that extra half a turn of EBITDA, or an extra 5, 10% more of consideration being cash on the table. Those are just really hard deals for an independent sponsor to win, right? I mean, one of the things, if I were to look at some of our more successful clients, they're typically focused on either proprietary deals or what I would call semi-proprietary, meaning regional investment bankers, brokers, maybe who are running a bit of a process, but not going to like 50 or 100 groups, right? And so, again, trying to be much more strategic about the targets you're going after. And as we talked about a minute ago, about building that relationship with the business owner, as you build that relationship, and if it comes across their focus on legacy, their focus on the second bite, I think that's where we see a lot of these win-win deals get signed up.
So on that third part with rollover equity and the second bite, how is that usually structured? With what are the different ranges of what you have seen for
Yep.
these size and shapes of deals?
And answer that question one sec. I think this is probably one of the biggest advantages an independent sponsor can have, if a business owner is also talking to a strategic, right? Somebody who's already in the space, right? Okay, that's obviously going to be a real buyer, probably maybe able to put a little more cash on the table at closing. But often, because of how they're set up, they can't really have the concept of rollover equity, right? I mean, they're a very large business. They've got their ownership group settled. They're not a financial buyer like private equity or like an independent sponsor, right? So right then and there, I always tell clients, hey, I've had a client a year ago trying to do a roll up in a sector, went through a dozen different sellers. The first, and there's like a lot of industries, there's a large strategic going around like a vacuum cleaner, buying up companies in the space. The first 11 business owners you talk to were all focused on last dollar. We're not focused on staying in the deal. That business owner, he's found one, he's an LOI now on one where that owner said, like, I would love to stay in. Let's build this together. Let's make it bigger, right? So I think that second bite, that roller equity range, is on the low end, I see maybe 10%. On the high end, maybe 40%. 20, 25%, not uncommon at all. I mean, sort of some real skin in the game. And typically that founder executive is staying around, whether it's to maybe staying in the CEO chair, but maybe staying in a key maybe on a board or an operating
Or
advisor.
handing over the key relationships, helping through transition
Exactly,
the team
exactly.
to the
Where
next owner.
and the beauty of rollover equity in the second bite is, of all the forms of deal consideration, it's the purest form of alignment of interest, right? Because now you have a seller saying, "I believe in my business. I'm going to take some chips off the table, but I believe in you, the buyer, that you're going to make this second bite work pretty well." And I've seen deals over, 5 years, 5 years later, that 25% bite, believe it or not, was worth more than the initial 75% the business owner took off the table, right? So the second bite can be a pretty meaningful piece.
Yeah. Are there any considerations to protect the independent sponsor on the downside when they're negotiating the rollover equity?
Yeah, I mean, one of the things that comes up a lot is sort of, the independent sponsor, often in partnership with a capital partner, whether it's a family office, an SBIC, whoever it might be, is going to put, cash equity into the deal, right? So one of the dynamics that comes up a lot is, hey, is that cash equity sit above the rollover equity, or is it pari passu, right? So that's one of the things that comes up. We spend a lot of time looking at deals with clients talking, hey, how is the rollover structured as preferred equity? Is it structured as common equity, right? Where does it sit in the stack? Are there any conditions on the rollover equity, i.e., if there's a cause employment event? Are there some could there potentially be the right to buy out the rollover equity early at a certain amount, right? So there's some interesting dynamics that come into play. But generally speaking, on a lot of deals we work on, rollover equity is often treated almost as if, hey, I bought your business for $100, Jordan. Here's $75 in cash, and here's, you know, putting debt aside for a minute, here's 25 shares of stock, right, for $1 a share. It's almost as if I handed you 100 and you handed me 25 back, right? You effectively bought that portion of Newco, right? So in many cases, you're entitled to keep that until the future exit or liquidity event.
Got it. All right. The fourth one, you were talking about the certainty of close. So, how can an independent sponsor improve the certainty of close, especially compared to strategics and funded sponsors?
It's a tough dynamic, right? And I think it's the elephant in the room in a lot of deals, right? So because a seller's often gonna say, hey, you know, Jordan's independent sponsor firm. Jordan, I love you. You sold me on, the space, you sold me on the second bite, right? I'm excited to partner with you. Are you going to be able to come up with the 13.4 million cash at close, right? Whatever that number is. And I think what you want to do as an I sponsor is you're certainly having conversations even pre LOI with potential capital partners, right? Maybe you're getting comfort letters or letters saying that, hey, we've had extensive discussions about the deal. We're very subject to confirmatory diligence. We intend to invest, or we're open to partnering. Sort of things like that. I mean, they're certainly not binding by any stretch, right? That's helpful. I think if you have
And
yeah,
and sorry,
yeah,
in those letters from the capital providers, do they also
yeah,
kinda explain what their process is of
sure.
like, Here's why we kinda like the here's why we like the deal. By the way, here's our process."
That's right. We're subject to seeing the quality of earnings report and confirming EBITDA, subject to certain other confirmations, right? We intend to partner or invest alongside, X independent sponsor, right? So that's one way to do it. Sometimes a lot of our clients who have started their own independent sponsor firms or are starting it came from private equity or came from investment banking and have a pretty deep Rolodex of connections and contacts, whether it's institutional or more high net worth. So, or maybe they can say something like, "Hey, I'm partnering with a wealth advisory firm and a number of their clients who like to invest in alternatives." Right? This is a wealth advisory firm with over $1 billion assets under management. Again, none of this is using the example I gave before. I can't point to, hey, here's 13.2 million sitting in a bank account. Right. And obviously, a committed fund or a strategic is always going to have that advantage, right? But, when you think about it, these generally are lower middle market deals. Some of these deals do have some imperfections, might be a customer concentration, might be some other sort of nuanced issue. And so, like any business, it's not the perfect business, right? So many sellers might say, hey, I really like this sponsor, and let's put a time period on that no shop or exclusivity so that, let's give them some breathing space to go see if they can do what they say they're going to do, which is complete their diligence, lock in the capital and then close.
So the next topic is um, what are the what are the key hurdles independent sponsors face to get an LOI signed?
Yeah, I think the days of being, there's really three, right? One is sort of what I'll call being a generalist. Second is sort of signing up a bad deal, and we can talk more about that. And third is sort of losing focus, maybe getting something signed up, but then not keeping the pipeline full, right? Those are really the three things that I see most often when independent sponsors struggle or struggle to get a deal signed up.
Sign an LOI with bad terms. Seems obvious on the on the face of it, like, don't sign a bad LOI, but, like, what are examples of
Yeah,
bad LOI terms?
I think, listen, you certainly have to get it in terms of enterprise value. In a perfect world, the highest you're certainly is at market value. If not, in a perfect world, you're a little below market, right? In terms of, because you built a relationship with the business owner, maybe you're getting it for half a turn or a turn less than that company might otherwise trade, right? Turn meaning multiple of EBITDA. Or you have a decent enterprise value, but the way you've structured the deal, like, I'll often see clients who, and unfortunately, we didn't get a chance to give them insights before they came to us, but they got an LOI signed up and it's got like a massive earnout, or it's got other features, it's got a seller note, but it's promising the seller, I'll get you all your money paid back in 3 years. When in reality, when we think about when the equity and or debt players come to the table, that's just not going to work, that structure, right? And so we're heading to a train wreck, 30 days out or whenever, when we find that capital partner and they're like, love the deal, okay with the overall headline number, but deal terms and deal structure aren't going to work for us. There's friction
I Yep.
on that point, and that's a really rough spot to be in, because now you've got to go back to the seller and almost try to recut the deal.
Well, I think this brings up potentially one of the most effective things that an independent sponsor can do for the LOI is go to a handful of the institutional
Yes.
capital providers, say,
Yes.
tell me what a great LOI looks like that you want to see from independent sponsors. Give me the
Yeah.
general structure. Give me the
Yeah.
terms on something that would be a smooth sailing for your IC,
Yeah.
as opposed to, someone who has not done any LOI. Like, the capital providers will work with you. They'll tell you
Sure.
what they want.
Sure. And the other thing is, find, everyone's got contacts with your trusted lawyer, your trusted accountant, investment bankers, I mean, call someone up, and even if it's without giving them obviously the deal name, say, hey, I'm looking at, an HVAC deal in the Northeast. Here's the size, here's the customer mix. It's, 60% new construction, 40% service on, and someone could say, yeah, that's a 7 times business all day long, right? Well, then don't go in and the seller's like, well, I want 9 times, because there's no victory in getting an LOI signed up over market. The only victory you've signed is you sign up an LOI, and then a month or two you're going to come to the conclusion that deal's not fundable, right? And you spend time and money and you wasted. So that's the last thing you really want to do at this stage.
Love it. All right. Next, let's go to the second big topic, which is the LOI execution stage. What is the perfect LOI?
Yeah. I think the perfect LOI does really three things. It syncs up with the vision that the independent sponsor has already articulated to that seller in terms of why they're a great partner. And it also ties into any pain points this particular seller has in terms of what they're trying to solve for, right? Number two, it plays up the rollover equity, the value of it, the tax efficiency, what it might be worth. And number three, when you read the LOI, there's clarity and structure in terms, as best we can sort out at this stage, where the seller and their advisors, and sometimes with these family owned lower middle market companies may not be as sophisticated, right, can really understand the deal, get their teeth around that type of things. Those are probably the three things I see as really for a perfect LOI.
Do you know of like an FAQ list of the top 100 questions that sellers and their advisors, sometimes maybe it's their local, attorney or their wealth manager who's just, they're helping them out. They've been with them for 10 years, but they haven't really done an M&A deal. Like,
Right.
is there a list of FAQ questions that we need to send them?
I'm sure there is. I mean, we've got, and your audience is welcome to reach out to me. We've got sort of template IOIs, indication of interest, and template LOIs that we've developed for different deals, right? We have short form template, we have a long form template, right? And many of those will dive into, in brackets, is there an earnout in this deal, different ways to structure it, et cetera, et cetera. So by going through, and there's different websites and database online, but by looking at, forms from your trusted attorney, looking online, maybe where you came from, your prior life, you have a good template or so you like, some combination of that, you can usually get a pretty good semblance of what should be in there.
All right. I think that would actually be amazing content to do a screen share of a template and just walk through, and I'm happy to ask dumb questions. I got a lot of them. Um, so into the uh okay, maybe here's let me think of a different way. What does what does what does a cringe-worthy LOI look like?
Yeah, and so I like the word cringeworthy, right? And it's funny as a dealer, I've had this happen a few times in my career where a client or maybe a prospect call up and say, "John, great news. I've got a deal for you to work on." That's great, Jordan. I'm excited working with you. I just signed the LOI yesterday. And I sort of like my heart kind of sinks a little bit because obviously I didn't have a chance to look at it, either give a few pointers about things that should come out or maybe things that should go in. But and so sometimes I'll get those and I just kind of like, do one of these, just kind of rub your forehead for a while. Where, I think the three things that are most cringeworthy we see are just over promising, right? Whether it's over promising in deal terms, the way that the deal is structured. I mean, just kind of giving the seller everything they want when in reality, that's not going to work, right? Um, and kind of related to that, over promising the seller, which then as a secondary cringe moment is now going to make it hard, if not impossible, for a capital partner to back that deal because the terms aren't just not going to work. And then last but not least, in the cringeworthy camp is what I'll call the ostrich, which is we know there's a key issue in this deal. There's a customer who's 60% of the revenue for this business, and the LOI makes no mention of it whatsoever. And we know that whether it's an earnout, whether it's an escrow, whether it's some sort of condition upon some of the deal consideration, that is going to be a key point. And to not bring that up now at LOI, and in 30 or 60 days, when we send a purchase agreement and say, oh, now that, we realize that customer is 60%, we're holding back, 40% of the deal consideration for 2 years or whatever we're doing, and the seller's gonna say, "Well, but you knew that. Why didn't you put that on the table at LOI?" Right? So if you know something is gonna be a major deal issue, then put it out there, right? Better that the deal not get signed up than again going back to the concept of we just wasted, a couple months of our life.
What are the different parts of that?
Yeah, I think listen, it's tough because when an LOI is getting signed up, it's the courtship phase, right? And the seller is telling you, "Hey, I want as much up front or whatever you don't get me up front, I want in 3 years and I don't want a lot of strings attached to future payments I'm going to get and I really don't want much of an escrow if any." I mean, we all know what a seller is looking for, right? But, and so to just give them their terms and get that signed up isn't really doing anyone a service, right? So really thinking thoughtfully at that stage is okay, for this deal, what makes sense for the deal, whether it's an earnout, whether it's how the equity is structured, whether it's, the terms of exclusivity, is there enough time to find the capital and get the deal closed, right? And spending, just negotiating in good faith, spending the time needed to get that LOI, those components right, right? Because again, the last thing we want to do is get an LOI signed up and then realized 30, 60, 90 days later, hey, we were too aggressive. I mean, there's no way we're going to find someone who's going to back this transaction with these terms.
All right. Next, let's talk about the post LOI phase. Um,
Yep.
when diligence goes right, what does that look like? What is a beautiful diligence phase look like?
I think a beautiful diligence phase is driven by three things. All of the trusted advisors around the table are very strong and know independent sponsor deals. Number one. Number two, the client, okay, is driving a timeline and process for everyone, both sides, buyer seller advisors to meet. And number three, the client and its advisors at each stage of the deal are setting up red flag stage gates that if something's going to go off the rails, we want it to happen sooner rather than later.
And how how hard is it to get the sellers and their advisors comfortable with a timeline and running a process? Because this is, a side of the market that doesn't do 10 transactions in a year.
Right, right. And no, it's a great point. And by its nature, let's just take an example. Let's say it's a proprietary deal, meaning there may not be an investment banker or broker involved at all, right? It's a business owner. It might be their lawyer, it might be their accountant, right? And so, the average proprietary deal, there are stats out there from initial outreach to a business owner to closing, it's about 9 months. 9 months for a proprietary deal, right? Because when you think about it, it makes sense because that company, generally speaking, isn't quite ready to transact. Because if there were a broker, an investment banker, there might be a data room set up, there'd be, more information, there's a management presentation materials. And the proprietary deal side, or even what I'll call semi-proprietary, a lot of those things don't exist, right? So really it's a function of the buyer and its advisors trying to figure out with the seller, hey, what can we accomplish here? Do you, the seller, I'm working on a deal now where it's pretty evident the seller doesn't have the resources to respond to our information requests, right? They're running a business. The business is doing great. And our client has encouraged them, bring in an outside accountant, bring in a finance person. You've got to bring more, you've got to run your business and you've got to fulfill these data requests. Help me finish the Q of E, the quality of earnings, right? So it's in some deals, the buyer almost has to sort of help the seller with the process, right? Because most sellers either don't know or don't have the level of understanding that, folks like you and I or who are doing this all the time would have. So,
So let's take like the inverse of this question because I think it's
yep.
equally as effective to understand the points. Like, what does a bad diligence process look like?
I think a bad process has, sort of three big concerns. One is there's smoke on a particular issue, but the client doesn't want to smell it or recognize it enough, right? That's one issue. Second is a key issue, business issue, diligence issue has been identified, but we're not bringing it up at the right time. We're almost waiting too long. Oh, I'll bring that up later, right? And depending upon the significance of the issue, that might be a really bad idea to do that. And third, once those risks are identified, thinking really strategically about, okay, how through deal structure, through indemnity, through insurance, how we're going to mitigate that risk, right? And build those protections in and having those sometimes uncomfortable discussions with the seller about what may need to change in the deal.
All right. And then our last one, or second to last one on post LOI. So let's talk about the capital component for post LOI. Um, what are some of the factors that most attract capital to a deal and just result in a deal getting done?
Yeah, I think I see five things most frequently. Number one, independent sponsors got a really nice deal signed up. It's in a nice industry or niche, right? It's at a decent enterprise value. There's sort of a nice structure with rollover equity. It's well designed. I think that's number one. Number two, the jockey, meaning the capital partner, loves what the independent sponsor, their team is bringing to the table. Number three, sort of the what I would call the partnership. The independent sponsor is open to a really strong partnership with that capital partner, right? Number four, um, a really well, whether the independent sponsor is doing it themselves or they're using the assistance of a placement agent, sort of a really well run process in terms of how they're trying to find that capital and trying to find the right partner. And then last but not least, number five, bring some of their own capital to the table, either from obviously from their own personal net worth, but as well as sort of a friends and family capital, because the more money they can bring to the table, sort of the better it will be for the deal and the better their deal terms will be.
So, I guess what does it mean to like push capital partners away at this stage? Like
Yeah,
post LOI. How do you push a good capital partner away from you post LOI?
I think, I've seen it. I've seen it. It could be, it could be arrogance, right? Just overlooking. I mean, listen, no deal is perfect, right? There are weaknesses in every company, and you have to be honest about those weaknesses. Whether it's I've got weaknesses in the management team, but here's how I'm going to shore it up, or I've got this huge customer concentration, but here's how I intend to diversify out of it, right? So really, just grabbing hold of those weaknesses in that particular business sort of head on and having a really tight, credible story as to how you, the independent sponsor, intend to address those. Because every capital partner is going to see those weaknesses. They're going to know what they are, right? And you got to have a credible plan to deal with that, right? I think that's, I mean, another maybe secondary reason we see sometimes is just um, maybe greedy is not the right word, but as a first time into monster, let's just you may not get the best economics, right? You haven't really built up a track record yet, right? So I think you can get good economics, right? If you're otherwise solving for a lot of the things that we've talked about on this podcast. But you do have to be a little bit realistic that it is your first deal, right? You haven't quite built that track record yet. So, you may have to take slightly less in the way of economics than you maybe had hoped to achieve.
Yeah. Well, let's dive into that. So,
Yeah.
what are the common economics for an independent sponsor for, let's say, a $10 million deal? What
Yep.
have you seen is the typical contribution that they bring, the typical like, equity provided from an institutional capital provider or family office? Like,
Yep.
what do the economics typically look like for a $10 million independent sponsor deal?
Yeah, there's probably great question. There's really three key components. There's typically a closing fee that's often 2% of enterprise value. Typically, the independent sponsor is being asked to take most or all of that in the form of equity, usually structured as LLC profits interest, right? So number one is a closing fee. Number two will be
But
management.
John,
Yeah.
I have been searching for 12 months. So I need that closing fee. What do you do in those situations?
Well, you might try to negotiate it up a bit more, or maybe you say, "How about I'll roll half or 75% in the deal, and I'll take the rest in cash." Right? So, it's like anything in life, it's a negotiation, right? And trying to convince the capital partner, "Hey, for this deal, I'm still I'm meaningfully invested, right? And so let me take some of that closing fee in cash to kind of, to your point, to cover some of that overhead, to cover some of those expenses that have taken a
Oh,
while
I
to
have a spouse that I got to answer to who's been looking at this bank account going down for 12 months.
Well, did you tell her I heard this at a recent, independent sponsor conference that being an independent sponsor is a get rich slow scheme, right? So go home and tell her that. "Honey, I've got this great idea. I'm gonna quit my day job. I'm making
But I thought
6
that was venture
figures."
capital, not
No,
not
no, no,
buyout
no.
private equity.
Yeah, there's a little bit of that here as well. There's a little bit of that here as
So
well.
so the first component, what's the typical contribution for a $10 million deal again?
Yeah, just running real quick through the three: closing fee, ongoing advisory and management fee, usually 5% of EBITDA, and then sort of carried interest, right? So in a $10 million deal, yes, the independent sponsor is going to be in asked to invest some of their own capital. Again, a sum meaningful to them. It can vary greatly by deal. I've seen deals as low as kind of low six figures, right? There are some capital partners that like to see 5% of EV or 5% of equity of the deal come from the independent sponsor or from the independent sponsor and sort of their friends and family, right? The theory being that if I have some of my friends and family money in the deal, I'm even more vested, right? Because I'm less inclined to kind of walk away from that, right? So that's a component. And then obviously, the most intense negotiation is often around the carry waterfall, right? So the independent sponsor says, "Great, $10 million EV deal. Let's go get 4 million of debt. I'll put 6 million of equity in, right? I get my equity back. I get a preferred return, often 8%. And then the question is, when at what tier does the independent sponsor start to see their economics, right? Is it until, in some deals it might be, hey, once the capital provider gets 1.5, 2 times their capital back, then there's a sharing, and whether that sharing is 90-10, and then might tier up to 85-15, 80-20. There's also a concept of a sort of a super carrier promote where at certain outsized returns, maybe it's 4 or 5x capital back, the demand sponsor might be able to get, say, 25% carry, 30% carry. So very, very bespoke, very much negotiated by deal, depending upon how attractive a deal, how experienced is the I sponsor, right? How much of their own money or their friends and family are bringing to the table. So it's a very sort of heavily negotiated, this and so the other components pretty heavily negotiated.
All right. And so last and potentially most importantly, how do we keep momentum to closing?
Yeah, I mean, it someone has to drive it. I mean, good trusted advisors, legal and otherwise, will certainly help with that momentum. But I think any good independent sponsor, either themselves or someone on their team, is really strong at really three things: communication, right? Communication to the parties, whether it's weekly calls or a cadence. Um, Driving everyone to goals. When are we going to finish the QV? When is this diligence going to be wrapped up? When's the on-site happening? Just driving goals and timelines. And then last but not least, and unfortunately I've had this happen before where I've picked up new clients and it wasn't their first deal. And I said, "Oh, well, what happened on your first deal?" "Oh, the deal died." "Oh, why did the deal die?" "Well, there was an issue with the seller, but I had an M&A lawyer who knew M&A, but didn't really know independent sponsor deals, right? And didn't appreciate some of the nuances, whether it was a more fragile seller or business, whether it was the dynamics with the capital partner." So I can't emphasize enough, pick a trusted advisor, lawyer, accountant, etc., who knows these types of deals, right? And I think it's a much small, if there's 100 good M&A lawyers, I'd say 5% of them fall in this camp. And the same thing I would say on the accounting side, right? So pick not just trusted advisors who know deals, trusted advisors who know independent sponsor deals, because they're going to help you navigate when you hit those hurdles and hiccups. They're going to help you navigate through them because they've been there, they've seen that, and they know how to help you address the issue.
All right. Okay, maybe I actually got another question. After
Yeah.
closing, post close,
Yeah.
like what does success look like?
Um, Having a phenomenal, really three things: phenomenal management team, right? Either whether you're riding the existing team that's in place, you think they're strong enough, or you're bringing in a new team or some sort of support to that team, right? An operating partner, strategic role. um, Having a thoughtful process to grow both organically and strategically. And strategically meaning, with add-ons, right? How are we going to identify them? What's our criteria going to be? How are we going to fund them? When's the first one going to close? At what point do we want to take this? We bought at 3 of EBITDA. Boy, if we get it to 10, we're going to market, right? And then third, last but not least, I've got another client who always says this: always be ready for sale, right? And by that I mean, you never know. You may have a 5-year timeline, but maybe you buy the business and 2 years later, someone a street knocks on your door and says, "Hey, I love what you have here. I'll give you your year 5 number now, or I'll pay you a turnover current value because I really need this asset. This fits in perfectly with what they're doing," right? So as best as possible, you always want to be ready in terms of having your processes tight, your documents tight, right? Because you never quite know. Certainly, when you're going to run an intentional process to sell, but you might get an unsolicited offer that you might say, "You know what? This is really good, and we should see if we can structure this deal and close this deal."
All right. Well, maybe this has been part 1 in the masterclass because we can go deep on each one of these
For
topics,
sure,
a whole
for sure.
triple click on them. Um, Thank you so much for taking the time for this.
Yeah,
And um, it'd be great to do some more content around this. I know that people are going to have questions on this, and so maybe this is part 1 of the independent sponsor masterclass and deal structuring.
happy to. Yeah, there's always
Awesome.
new stuff going on in space, and it's the space. No, I think you and I talked about it last time. No one knows how many independent sponsors there are. I mean, I've heard over 5,000. But I mean, I'm probably getting an outreach a week where someone says, "Hey, I'm forming my firm. I'm thinking of forming a firm. I'm launching my firm." You know what I mean? So the relatively speaking, the barrier to entry is low, right? It I always tell people the most important thing you need is probably 2 years of cash saved up to cover yourself and your family, right? Because you need to assume you're 18 to 24 months away from closing your first deal. Hopefully, you can get it done quicker, but if you go with that attitude, your odds of success will go up dramatically.
And if you had to make a best guess on the out-of-pocket expenses that are deal related for a $10 million deal, what does that mean?
I think your biggest expense is probably going to be QB, the quality of earnings report on the accounting side, right? That could be anywhere from a 50 to a $75,000 number, sometimes more, right? That's a material item, right? With legal, you often kind of hold off a little bit on legal work until the QV comes back. You've confirmed the EBITDA until you're a little further along with your discussions with capital partners. So there's some legal spend on the front end, but we can also we can usually wait a little bit to kind of ramp legal up until there's sort of a higher go. But the accounting finance diligence that needs to happen out of the gate, right? Because until we confirm the numbers, we don't know if it's a go, right? So that's probably the number one expense I see, just being able to bear that QV.
All right, this is awesome. Thanks a
Thanks,
lot for doing
Jordan.
it.
Yeah, no, this is great.